Imagine we're sitting at a poker table. Everyone's got chips stacked high, and the game's been going for hours. We're all excited to see all of this money in play. And all of a sudden, one guy maybe has the biggest stack of chips at the table. Well, he quietly just picks up his chips and takes off. That is what just happened in the private debt markets. The chips that got taken off the table out of this economy, we're talking about tens of billions of dollars. Well, why do you care? Because these debts don't just vanish. Bankruptcy might be a way for a creditee, for a borrower to clean up their balance sheet and do away with debt. But one person's liability is another person's asset. Welcome to the Debt Doctor Podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good afternoon, good morning, or good evening, wherever you're joining us from today. Welcome to the Debt Doctor's office. I'm Bill Bymel, and today we are going to talk about two huge canaries in the coal mine that just died last week and how it may impact the larger economy and what the ripple effects of that might be. It's a big debt loss. It's a big debt bankruptcy, and we're going to talk about it today. For those of you that are joining us for the first time, I really appreciate you joining the Debt Doctor. We are promising top quality, prescient topics with interesting conversations with people in and around the world of debt. For those of you that have known me a long time, you know this is my second podcast. I've spent over 20 years in real estate and mortgage finance. After a 3-year stint as the real estate lowdown, we started the Debt Doctor specifically to talk about real estate debt, but there was another reason. There was a reason because I see other types of debt in and around our society as being much more concerning than real estate debt. And the crisis that may have unfolded in 2008, that's not coming again. Yes, there's people struggling. Yes, there's foreclosures on the way. Yes, there's shadow inventories. For those of you who are friends and colleagues of mine in the distressed real estate business, who, we're all kind of chomping at the bit with the expectation of new deals, new opportunities to either purchase or manage. And that is all coming. But that's not where the next crisis is coming from. If anything, real estate may be the safe haven. Before I kind of get into all of the details of what we're talking about here today, we are going to be talking about the bankruptcies of two non-real estate related entities, multi-billion-dollar corporations, both in the auto sector, who have huge multi-billion-dollar debt liabilities to major financial institutions. And it's looking pretty clear that a lot of that debt is going to be a complete write-off. But before we get into why that is, if you are new to the Debt Doctor, Please like and subscribe, whether you're watching us on YouTube or listening to us through one of our various podcast networks, Apple, Spotify, the Google Play Store. It does make a difference, not only that you subscribe to this free service that is meant to be entertaining and educational and prescient, but it also makes a huge difference when I bump into you, when I get notes from you, when you make comments on our videos. Last week was fortunate enough to spend a few days with colleagues of mine in the distressed real estate business at a event in Dallas, Texas. It's called the Five Star. It's been around for over 25 years, actually. It's a Five Star Institute is a think tank group, educational group surrounding mortgage and real estate industries. Had an opportunity to bump into many of you, and I have to say thank you. Thank you for all the kind words you say, for the fact that you are listening to this show or watching us here on YouTube. I do it for you. There's nothing more. I'm not looking to make a buck out of all this. It's to be a voice of the industry, to be someone who can share real conversations, real content, most of the time, no politics involved, and really just have, interesting conversations. So when you come up to me and say, hey, it really makes a difference, it really does make a difference to me to hear each of you and your comments, and the fact that the work that we're doing here is is valuable to you. And thank you for that. We don't spend a lot of time looking to beat the algorithm. We don't do bombastic, AI driven, titling, and although maybe this one should be the one that we take a shot on. It's not meant for that. It's meant to deliver a class act. And, so back from that. So let me talk to you about two names that you probably had never heard of before the last week or two. And I've only heard of it through a fleeting passing line in your newspaper or your internet news feed or on your evening news. And these brands are Tricolor and First Brands Group. Both of these companies, unrelated to each other, went bankrupt in the last week. And, while these headlines might sound like just any other bankruptcy filing that really doesn't have an effect on you, I want you to picture this. Imagine we're sitting at a poker table, all of us in this U.S. economy. Everyone's got chips stacked high. I don't know if any of you are poker players. And the game's been going for hours. We're all excited to see all of this money in play. And then all of a sudden, one guy maybe has some of the biggest stack of chips at the table. Well, he quietly just picks up his chips and takes off. That is what just happened in the private debt markets last 2 weeks. The chips that got taken off the table out of this economy, we're talking about tens of billions of dollars worth of debt. By the way, they were a liability to these companies, but they were an asset to many other companies, including some major financial institutions. That money is gone. Yeah, they're going to try to seek stuff through bankruptcy. They think they have lien positions on goods or items of asset value. But boy, this is the canary in the coal mine. This is the kind of thing that I've been talking about with friends and colleagues. When we sit around the bar or the coffee table or dinner, we often say it's not going to be like 2008. And that's true, because the asset-backed securities market was really only had the real estate business to play with prior to 2008. It was generally considered asset-backed securities generally needed to be fixed items of substantial value without the ability to be disappeared or depreciated. That's real estate, right? So prior to 2008, the asset backed securities network came in and created all these crazy debt scenarios, selling products around to retail investors and to wholesale investors, private equity firms, and banks. And when that whole bubble blew up, the real estate market itself was also didn't have the backstop. That's not what's going to happen this go around. If anything, I think we could see a little baby bump in real estate as a result of a crisis coming in other private debt markets. And it's this kind of canary in the coal mine that I believe will finally be the black swan, so to speak, that wakes up stock market investors and the general economy into like, hey, wake up, it's reality time. Let's talk about what happened with Tricolor and First Brands. So, first of all, Tricolor, think of them as a buy here, pay here chain of auto lender. Okay. They're like the buy here, pay here on steroids, though. The entire business model was specialized in lending to subprime auto buyers. What is a subprime auto buyer? Someone with bad credit, maybe someone without a social security number, without a job, someone who, is not someone that could get a regular bank loan or a loan from a major auto company like Ford Auto Credit or Tesla Credit or anything like that. So, and that, by the way, is probably a large portion. I don't actually know the stats on that. We'll look it up, but that is a large portion of the auto lending market. Well, at the time of their collapse, apparently, this multi-billion dollar auto lender that was doing fine just 2 months ago had over 25,000 creditors. Their liabilities? Somewhere around $10 billion. Creditors that you do know the names of, by the way. Creditors like Fifth Third Bank, JP Morgan Bank, Barclays, Origin Bank. This is a storm that is still unraveling, and the dust of this collapse of these two companies has not settled yet. I am recording this in the first week of October 2025. Mark my words, you'll look back on these. Maybe this is just the first of a series of major private debt related bankruptcies. And maybe it's not the black swan that wakes us all up. But this is certainly a canary in the coal mine, and it is certainly a major, major deal. Fifth Third Bank alone had to admit that they're staring at about $170 to $200 million loss. And that's not some tiny write-off. That's a number that makes shareholders flinch and CEOs go very quiet on quarterly calls. I took a look at Fifth Third's balance sheet the other day, and they're a pretty big, I think, $90 billion bank with, I don't know, $70 billion in liabilities. Net, they're still, they're probably still got, 10, 20 billion in equity value. So, well, a $200 million loss on a on a $90 billion bank looks pretty small. But when you look behind the covers and realize that their net equity value is closer to 20, that means you're talking more like a 1% of their book that just evaporated. There was nothing on their call reports last quarter that indicated anything in the auto sector to the size of $200 million that was even non-performing. As a matter of fact, in last quarter's Fifth Third call reports, they only showed a $40 million non-accrual book. So now that's in auto finance. That means they're about to add one loss that is 5 times their entire auto loan loss as reported. On the other hand, First Brands, who we'll also talk about, First Brands is an auto parts maker. If you've changed your oil, you know Fram. First Brands owns them. If you've replaced wiper blades, you've touched Trico. That's a First Brands brand. If you've driven your car long enough to the point that you've had to replace the brakes, Raysbestos brake parts is a First Brands brand. Well, the parent company of First Brands filed bankruptcy last week, reporting $11.6 billion in liabilities. And here's where it gets even really wild. They are already indications that they may have double pledged over $2.3 billion worth of receivables, assets that they pledged to get more money, to get some of that $11.6 billion in debt. And there's even talk that they may have cross-collateralized amongst various lenders almost 400, about 376 million in inventory. That's what the early reports are coming from bankruptcy filings, combined with lenders and creditors coming out of the works trying to make claims on assets and of this company, this First Brands. Now, not to mention the implications here. Let's just talk about why this matters, because it could have huge implications on everyday life as well. But we'll come back to the financial implications. Well, why do you care? Because these debts don't just vanish. Bankruptcy might be a way for a creditee, for a borrower, to clean up their balance sheet and do away with debt. But one person's liability is another person's asset. And the private debt markets is where we've said there's way too much opacity. There's way too many private debt deals being done that are complicated based on assets that are really not tangible, not super collectible. And the corporate debt market, we've been screaming from the rafters here at the Debt Doctor that these markets are sick and that there are viruses in the form of fraudulent companies and bad lenders and bad investors in these markets. And this may have been your sign today when we talk about First Brands. Onset Financial, apparently a firm I've never heard of, says they are owed close to $1.9 billion. Now, let me tell you something. Even asset-backed loans, but when you're talking about assets like parts or factoring of receivables or anything that's not fixed, business supplies, factory machines, inventory. When you talk about all that stuff that is not like tied down, not real estate, that's more like credit card. And credit card debt, when somebody files bankruptcy or credit card debt goes bad, lenders usually sell that for somewhere between 5 and 15 or 20% of the debt value, which means that in their minds, they're writing this stuff off. Imagine a company like Onset Financial. Well, where did they get their $1.9 billion from to lend to these guys? If they have to write off 80% of that, well, they're out of business too. There's other names you can do some research on. Evolution Credit Partners, Acquium Capital. These are private debt funds that all of a sudden now are making claim to the same receivables and inventories, which means the borrowing entity, this big, successful, grade A auto parts manufacturer, or this very profitable subprime auto lender, all of a sudden now it looks like there was major fraud going on inside those companies. Think Enron. And don't forget the banks we mentioned: J.P. Morgan, Barclays, Fifth Third, South State, CIT, First Citizens has a huge exposure. Now, if you know who First Citizens are, they are a combination of several failed banks. So they've been on a little tight string to begin with. And none of these folks had any mark on these loans, at least that we as the public could see. If you go back and look at the call reports, you look at any of that, this was a wake up call to these lenders. Billions of dollars that will probably never get repaid, certainly not in full. Maybe they'll get 10 to 20 cents of their dollar on in bankruptcy court, even if they got 40 or 50%. But when banks and funds takes write-downs that large, you can't just shrug that off. How does that affect the everyday consumer? Well, you're going to see interest rates jack up. Let's look at the auto lender situation is even more interesting. I'm going to pull up something that I read this morning just to think about it from the auto lending standpoint. If you're a subprime borrower, okay, folks that might need a car to get to work, they don't have perfect credit, they, whatever, they're about to find fewer lenders. This was one of the largest subprime auto lender in the country. Fewer lenders out there lending to them means rates go higher, terms get tougher, repossessions get quicker, less mobility, stuck situations. If you're a manufacturer using or uses factoring as a way to get debt, on the private debt markets, we just see a major factoring deal blow up. Well, that supply chain finance to make payroll, everything like that, good luck. Those rates are gone. Maybe those lenders are gone. You're talking triple the paperwork. You're going to see a whole ripple effect coming out. I mean, think about it from the point of view of the subprime auto lenders. It's like if we live in a neighborhood where the house next to you burns down and caught on fire, even if your house is fine, that insurer is going to raise everyone's premiums. That's what's going to happen in private debt. It's going to create a chain reaction, in my opinion. And then for investors, these are not small write-offs. This is a big wake-up call. I'm going to a new piece of information came out last night about the Tricolor situation. Tricolor, remember, is the one that was the subprime auto lender. Okay. Now, apparently, at the time that Tricolor closed down, they had about 100,000 auto loans out there, and something where over 50% of them were still performing. And the bankruptcy court has actually approved a special servicer called Vervent to come in and take over the existing portfolio, keep collections in place now that Tricolor as an organization is gone. But here's something interesting. In addition to all this cross collateralization, that there's multiple lenders that are making claims on both companies' assets, on what appears to be the same assets, which may be an indication of fraud inside either. Apparently, 30,000 vehicles marked for repossession by Tricolor are now missing. Considering that they had 100,000 loans in their own book, that means that 30% of their loans that were in the process of repossession are worth absolutely zero now. They're gone. And that's interesting because when you look at the S&P's June ABS pre-sale July report. So this is again, I remember I mentioned asset-backed securities because the securitization market is where this liquidity comes from. It's the same market where mortgage-backed securities blew up because of shady shit that was going on. So ABS is where a lot of these auto loans get sold through asset-backed securities. We haven't seen this ripple effect. But as of July, the ABS report on this company said that only 10% of their loans were 90 plus delinquent. 90 plus is kind of the general marker by which we take debt. We consider it officially non-performing. Because statistics show over and over again in any asset class, mortgage, credit card, auto loans, student loans, that any borrower who falls over 90 days past due, more than three payments past due, the chances that that borrower will be able to fix that problem, get out of that, drop tremendously, like into the teens, like way below a quarter of the population of borrowers. That's where the 90-day plus number comes from. So how is it that in July this auto lender was reporting to the ABS market only 10% of their loans are 90 plus, and now we are in end of September, so less than 60 days later, 30,000 of their $100,000 loans, $100,000 of loans have now just disappeared. So, their backup servicer just recently gained access to these premises. So it'll be interesting to see what comes of it, what new information is found. You want to know, by the way, where a lot of these cars are expected to have gone? Well, if you think about the subprime auto borrower being a good portion of those being foreign national workers, many of whom may have been undocumented or concerned about being questioned on their documentation, and the whole self deportation program that has kind of gone on just this year since the beginning of this new administration. Well, it is now already being talked about that they think that a lot of these 30,000 missing cars that are no longer, for missing for repossession, may have driven themselves over the border into Central and South America. That's an interesting ripple effect we could probably hear more about later. Here's the bottom line, folks. Tricolor and First Brands are the early warning sirens in private debt markets. I have been saying that you're not going to see a collapse in debt come from real estate in the first place, at least not first lien real estate the way we did in '08. It's not going to look like that. It's years of easy money that created new structures for borrowing and investors chasing yield at any cost, new asset-backed securities. When I spoke about this, I'm not sure if it was on this podcast or in one of my previous podcasts, I have spoken about the fact that the asset-backed securities conference, the same conference that they make fun of in The Big Short for its craziness over mortgages. Well, that conference this February was the largest attendance since 2009, 2008. I wasn't listen. I heard very little conversation about mortgages. I heard a lot of people excited and pawning and building these securitization platforms for things just like what Tricolor and First Brands were borrowing their money for. Using inventory, using receivables, securitizing loans against automobiles, securitizing loans against equipment, securitizing anything. You can go back and see there is an article in late February, I believe from the Wall Street Journal, that points to that you can basically securitize anything. And the issue is that because they're private debt markets, because they're unregulated, because it's so hard to delineate one product from the next, it's hard to have any real insight into what's going on. It's ripe for fraud, both at the securitization level, at the issuer level, at the borrower level, all across the board, this easy money. And it came to an end when interest rates started to go up. The stress started to hit. These are not just cracks, folks. These are sinkholes. So if you're an investor in private debt markets, ask yourself, do I really know what collateral my money is backed by? If you're a borrower, you can expect your lender to get pickier. And if you're just watching the headlines, remember, these aren't just isolated bankruptcies. They're the beginning of a larger pattern. They're a canary in the coal mine. And as I always say, debt doesn't disappear. It moves from one to the next until someone has to own it. And right now, banks, private lenders, or just private equity firms are just starting to find out how heavy that burden might be. Thanks for listening to the Debt Doctor. Stay informed, stay cautious. I'll catch you next time. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.